Welcome to the Phoenix Prosperity Podcast, where wealth meets legacy. Join your host, Tim Fergestad, as we explore the journeys of Phoenix's finest to success and beyond.
Hello, this is Tim Fergestad. Thank you for joining us. I'm very pleased to have Blake McGilvray with me here today. Did I say that right?
McGilvray, yeah.
McGilvray.
It's a tongue twister.
Okay. It says in your bio you've sold cutie clementines, then worked in a fintech startup that went full cycle.
Yeah.
And now you're sharing your wisdom in note brokering, helping lenders sell their performing and non-performing notes. Is that right?
That's correct. Yeah. Exactly.
Excellent. All right. Well, thank you for joining me. Welcome to the show, Blake.
Appreciate you inviting me.
All right. How about a little background on how you got in, how that story arc, that origin story led to running a note brokering company? Yeah. And then maybe we can explain for our listeners what note brokering is.
Sure. Yeah. It's a great question. So I actually graduated in 2008 from college and got into real estate in construction. And that was obviously a very bad time. I joined two companies that went under within several months. And so I decided I needed to have a switch. I ended up working night shifts at the Los Angeles wholesale produce market. So 11 p.m. to 10 a.m. I was selling to some of those vendors that you see on the side of the road, as well as some local markets. From there, I ended up joining Sun Pacific, which is the largest independent navel oranges producer in the country outside of Sunkist, which is a conglomerate. They're the largest individual. And they also started the Cuties Clementines and then also the Mighty's Kiwi. And so they're connected. So I met with them and got a job with them. I worked there for 5 years. And then I realized, sales is kind of my thing, but citrus is not. And so I thought, I want to get into something that's more technology and sales and something that's more innovative. So I found a fintech company that a friend of mine was working at, and he brought me on board, and I was the 32nd employee at Pier Street. And we grew to over 300 employees. We did over $5 billion worth of mortgage notes, and then COVID hit, and so that's that kind of took our knees out from underneath us, and we ended up winding the company down, filing bankruptcy in June of 23. I stayed with them for another year to try to help wind them down. And what that fintech company did was they would purchase loans that had been given to borrowers of non-owner occupied, and these are business purpose loans, non-owner occupied investment properties. We would purchase those notes from these small private lenders across the country. And then we had two channels to sell it to. We either had the retail channel, which is what I primarily ran, and managed a lot of the retail channels. So we had over 12,000 funded accounts of individuals who would invest as little as $1,000 into these mortgage notes and get a 6 to 10% return. And then we also had another channel of selling those whole notes instead of fractionally. We'd sell them as whole notes to large institutions. And then when COVID hit, our volume really crashed, and we were a company that was we needed a lot of volume to kind of keep going. So, yeah.
Okay. What types of notes again? These are commercial and residential.
Yeah, we focused on single and multifamily, typically 1 to 4 unit multifamily.
Okay.
We did do some larger complexes, and we did dabble a little bit in industrial, but we didn't really know what we were doing too well in that, and so that didn't really pan out for us. So we really did a great job at the single family and the 1 to 4 unit multifamily. Right. Okay. Our investor base, our retail investor base, really could understand that. A lot of them had homes themselves because they had to be accredited investors. So it was understood that they know what a mortgage is.
Yep. Okay. So I was I was thinking, if you had a lot of retail office space or something and things in COVID, that I could have seen that could be good or
Really
bad,
tough.
right? A lot of notes
Yeah.
trading, a lot of people wanting to get out of things, and you can get a lot of notes at a discount probably.
Yeah.
And so I didn't know if that market would have been better during that time.
Well, note trading, it's kind of just always there, right? Whether
Right.
the economy is doing well or not, or real estate's doing well or not. You're either selling performing notes when the economy is humming along, because that's where the money is, and that's where everything's going. And then when things start to crash, like you've got opportunities in that non-performing space. So people are trying to offload some of their bad debt, and so that's where we step in as note pros, which I started last August with another former peer streeter. So that's what we're doing now is we're actually transacting and selling those notes between these small private lenders and these institutions and even individuals who like to buy these notes.
Okay. So what was the nature of COVID disrupting that?
Well, what COVID did was we were all non-owner occupied business purpose loans. So these are investment properties that
Right.
typically, for example, a fix and flip.
Yep.
And so when COVID happened and interest
So these are
rates
shorter term loans. Okay.
12 months, typically 12 months.
Okay.
So when COVID happened and interest rates dropped to the floor, it was homeowners were actually purchasing properties for 120% of value, whereas our borrowers were really trying to purchase these properties at 20% below value. So there's a 40% delta there.
Okay.
Our loan volume dropped from about 250 a month to less than 25 million a month. 250 million to less than 25 million a month.
Okay. Yeah. 10%. Okay.
Yeah.
Huh. Okay. I see that now. Okay.
Yeah.
And that just isn't sustainable for that size.
Yeah, certainly not. And while we did have some aspects of the company kind of start humming along, at that point we had what's called a DSCR loan, debt service coverage ratio, rental properties. Those were taking off because interest rates were low enough that the borrowers could service it with someone renting the property. But it just didn't keep us afloat. So
Okay.
yeah.
Okay. And so you had all this knowledge and resources and so forth. And was that the first time you started your own endeavor?
I technically no. I had tried to. I created an entity because I wanted to do some flips myself.
Okay.
And that was in 2019. I created it in December of 2019, and then I ran up against as being it was going to be a fix and flip is what I wanted to do. And I was running against homeowners paying 120%, and I just didn't see. I could see it being a short-term opportunity, but not very long-term. And so I pulled out of that, and I just maintained with the company for 4 years. And the last one was brutal because that's when we were in bankruptcy, and then it was after that, a couple months after that, that I had decided to create this company with my partner.
Okay. A lot of people know there's a lot of money to be made in real estate. It's a strong investment class. A lot of people watch shows, flipping shows and stuff, and they get excited and they want to go do it. And they often do overpay, and the first one or two may or may not go as they expect. But a lot of people start realizing that it is a job, that it's very transactional. It takes a lot of time. It's active, right? And so a lot of people, when they learn that, right? They want the advantages of real estate, but then they get some experience. I've noticed that they sometimes try to just scale. They get good at it, and they start doing more and more and more and more, and that gets different problems. But they either go into bigger properties or they go into lending and note trading, and it seems to be the two ways to grow and get a better return on your time and energy, right? Because notes can be pretty passive compared to swinging a hammer and leasing and everything.
Yeah, it's funny with the passive income that all these gurus talk about. Well, when you're a landlord, it's not always that passive.
No.
But yeah, so I mean, there's two sides of almost every real estate deal, right? You've got your equity side, which has unlimited upside, but also unlimited downside, and then you've got your note side, which is your debt. And typically you have a limited upside, but you typically have a limited downside as well. So it depends on what your risk appetite is. And so, yeah, there's definitely both sides, and there's definitely plenty of money to be made on both sides. So, for example, right now, I don't know what you get on any equity right now. I don't really focus on that. What I focus on is debt, and debt you could easily get a 10 to 12% return, annualized return with these notes. So that's a pretty significant return, and you've also got downside protection, which is very important.
Right. Compared to, say, like a CD where you have to lock your money up right now at a bank for 12 months or something or more, depending on, there's some shorter ones, but for 4-5% maybe.
Yeah, exactly. Yeah.
Yeah, that makes your note options a great opportunity.
Yeah. And when interest rates are low and those bonds are producing significantly lower returns, so are the notes, right? But at the same time, it's all about the risk profile. So that's what we've kind of focused on.
Right. So let's speak a little bit about conforming and non-conforming, if you don't mind.
Sure.
Different parts of the market cycle, right? You have more of one than another, but where's the better value for note pros?
Yeah, good question. Right now, we're seeing, and it's not even the conforming or non-conforming space.
I'm sorry, just to back up. Let's explain to people what we're talking about.
Yeah, fair enough.
Right, when people stop paying on their note.
Yeah, so it's really not the type of loan, but more what kind of asset class is it currently in. So we broker deals, if you will, of performing, non-performing, scratch and dent, as well as DSCR loans. So in particular, what you're talking about right now is the non-performing loan space, and we call that an NPL. Non-performing is when a borrower stops making their interest payments and the lender begins the foreclosure process. A lot of lenders are not meant to or built around or have a heavy asset management team to kind of handle a lot of these defaults.
If you buy a house from them, they finance it, and you don't pay, they say they'll take back the keys.
And so what they'll do is they'll sell their note to try to recycle their capital.
Right. They don't want to do that. They're not in the business of being landlords. Right. Okay. Yeah. So these lenders will give out a note at a 10 or 12% interest rate, and then also charge 2% to originate the note. And so they want to originate notes and recycle their capital. So one thing where we help lenders is really balance sheet lenders that give their own money out to these borrowers. So say, for example, you've got a $20 million fund and you lend out $20 million as a lender. You're not just going to close your door, go sit on the couch and wait for a borrower to pay you back and then find another borrower to give that money to. What we'll do is we'll try to transact on that note, and we'll try to get that note sold for that lender. And this is on the performing side. So a performing note, you can sell it in many various ways. You can sell it as just par, just give me all my money back and we're good. Now you can sell it at a premium. So $1 million note and you have to pay $1,010,000 for the note, or at a discount. So you could purchase the note at a 1 or 2% discount. Why do you do that at a discount? Just to recycle your capital, because maybe you're running out and you've got a borrower that you want to service. And a really poor marketing scheme would be to tell your borrowers and your clients to go somewhere else. Right. And so we help these lenders recycle their capital so that they can service their borrowers better. Right. Okay. Yeah. Okay. And then when loans don't perform, that lowers the value of the note, and potentially
typically we're actually seeing it's really interesting. That's where we're seeing our most success right now, is the NPL, or the non-performing loan space. So we're seeing bids across pools. We typically sell a pool, not an individual loan. We'll sell pools of 5 to 150 million. And we're seeing bids really in the 90s all the way to 120% in terms of on the loan level. So each loan will be individually priced. And what that means is just for simple numbers, let's say a property is worth $2 million and the loan or the note on the property is for $1 million.
Right.
Well, the likelihood of losing money on that loan is extremely low.
Right.
And so even if you're a buyer even if you default on that loan, you could probably sell the property, pay the loan off in full, and you're totally fine.
Right.
And if you're a lender, you're fine as well. But what if someone wants to come along and say, hey, look, I'll pay you 110% right now. You walk away, you get your 10%, you don't have to deal with this. I'll then collect the 18% of interest that's been accruing on that loan from the borrower. So I net 8%. And if not, then actually what I'm going to do is foreclose on the property.
Sell it for $2 million and
make way more than 8%.
1.3 million and still make some money, right?
Exactly. A phenomenal return. And some of our clients in terms on the buy side, they actually are single family rental companies. So their objective is actually to foreclose, either get a 18 to 25% return on some of these if the borrower pays it off, or they're able to foreclose on the property and then they turn it into an income producing property.
Okay, so they're I don't know what's the term for that. If it's not predatory, but they do want you to default, is there a term for that?
Yeah, well, I mean, the obligation is on the borrower to pay the loan off in full, right? They signed a contract, and so it's not predatory if you allow them to pay it off. It's not predatory.
Right. You're following the rules. You're like, hey, pay it off. It's yours. But if you don't, I get the house. I'm kind of hoping you don't because I want the house.
I'm living up to my end of the bargain on this contract that you signed, even though I purchased it from someone else. Right. You know, that debt I got from someone else. It's, you know, this is what I need as your lender, because I'm now your lender.
Those are the risks lenders take, right? Because things happened like 2008, right? There was all those lenders were saying, if you don't pay, right, we're taking the property back. And then people were like, here's the keys.
Yeah.
The lenders are, can get caught in trouble.
Yeah, we're dealing with a lender right now who's got hundreds of loans with individual loans tied to individual properties that at least on 60 of them, 50 or 60 of them, they're looking to hand the keys back. And so we're trying to facilitate a sale there too. They're trying to hand the keys back and just say, hey, look, I just don't want a foreclosure. I don't want to deal with any of that. I've got more loans with you guys that are not in default. Let's just try to be amicable about this and see what we can do. And so it's not always, trying to take someone's house. That is not what it is. It's about trying to get a good return. And you can do that, especially if you're purchasing the note at a discount. So again, for even numbers, let's say a property is worth $1 million and there's a note on it worth $800,000, right? In terms of that's what the principal was. Well, you could buy that note at, call it a $700,000, so $100,000 discount. And then you can go to the borrower who the borrower might owe, if they owed $800,000 plus an additional, call it 20% on it. Let's just, again, for even numbers, let's just say they owe $900,000 to the lender. Well, if you buy it at $700,000 and you go to the borrower and say, hey, look, just pay me back the $800,000 in the next 60 days. The previous lender wanted 900. We just want 800. The property is worth $1 million. You should be able to refinance this at 800,000, and we walk away with a $100,000 profit, and we're good.
Right.
In 60 days. Sure.
Yeah. I mean, that industry, borrowers should be very, very grateful there is such an industry and that people do want to buy notes, and it gives them a lot more options, and particularly when they run into trouble and there's other people willing to take some of these from the bigger lenders who don't have the time or energy to deal with stuff like that. So how can you speak a little bit about, before we get into more about Note Pros and how people can invest and stuff in it, just the nature of the industry and how loans get packaged and sold, and there's bigger players and smaller players, and can you lay that out for us, please? Yeah,
so there's definitely lots of different players. We focus primarily in the RTL or bridge loan space, so residential transition loan. What that means, it's just a short-term loan. It's not a 30-year consumer loan. These are business purpose loans. So the actual foreclosure process is completely different. Well, not completely. It's slightly different than foreclosing on someone who's living in the home. And so that's
owner occupied. So
correct.
The borrower occupied, maybe in this sense.
Correct. Yeah.
Okay.
And we run into situations where these borrowers are actually occupying the property.
Even though they signed a note saying they wouldn't.
Yeah, they signed a declaration of non-owner occupancy, but here they are living in it. That's just people just being slightly fraudulent, if you will. But it doesn't really matter too much. It doesn't impact the note too much, other than, okay, maybe I'm going to have to evict this person now.
Certain laws in different states dictate different protocols.
Yeah, but back to your question, lots of players. I mean, this is multi-trillion-dollar industry, right? So we're sitting here, and in the RTL bridge loan space, that's more of a private loan space, so non-banks. Banks are heavily regulated, and they do huge numbers, especially with owner-occupied consumer loans.
Right.
We try to focus on the non-owner-occupied business purpose loans. That's kind of just where we see our niche, if you will. And
so for our listeners, that's somebody who's renovating a home for a rental property or investment purpose.
Correct. Or exactly. Rental, fix and flip. Or someone who's just looking for a loan, a bridge. Maybe they had a 30-year note with Bank of America, and they're like, oh no, my mortgage is maturing, and it's been 29 and a half years. I need another loan, and if I go to Bank or Wells Fargo, they're going to take 3 months, let's call it, to go through all my documentation, blah blah blah, to give me.
And I'm in a hurry.
Maybe a month.
Right. I'm in a hurry. I need something quality fast. And maybe they're like, well, I don't want to get a whole new 30-year and pay all the fees. I'm going to probably sell it within 12 months. So I'll just get a transitionary gap loan.
Absolutely. Exactly. Yeah. We call those bridge loans. Yeah.
Okay.
So there's no construction component to it, no rental component to it. It's just simply, I just plan to sell this in the next year or something like that, or get another refinance in a year. Yeah.
Right.
Yeah, absolutely.
Okay, but so you were saying different players stacking and combining these to sell the bigger ones, and
well, what we do is we connect with these smaller private lenders. Again, let's say they have a $20 million balance sheet. They might have $2 or $3 million of loans that they want to sell. Mm-hmm. So we connect with a lot of those smaller lenders, and then we also connect with multi-billion-dollar institutions and lenders themselves that want more access to more buyers. They might have an asset management team that's really good at getting the borrower to either get back on track with their loan or foreclose on the property or something along those lines. But what we do is we're kind of a mix between an asset management team and a capital markets team. And capital markets, sells the notes. So what we do is we try to combine those and reach out to a lot of these buyers and just say, hey, look, what are you looking for? And then we'll find what they're looking for and pass it off to them. So right now we have about 100 different buyers. And I like to break it into kind of two different asset classes of performing and non-performing. We've got about 30 buyers of performing notes, and I'd say about 65 of non-performing. And that both of those pools range from anyone from individuals to 30 billion plus institutions.
Okay.
Yeah.
Okay.
And pools, yeah. So typically we'll handle a larger pool. So our last three pools, to give you a sense, are 31 million, 42 million, and 6 million.
So these big institutions don't want to buy Joe Blow's fix and flip loan. They want to buy 30 of Joe Blow's fix and flip loans.
Correct. Yeah.
It's not worth their time to transact on all those smaller ones. And do you guys package them yourselves?
We don't, package them. It just depends. We typically, send them out in a pool. So a pool or a tape is just like, hey, look, we've got this one lender that's looking to sell their notes. Send that pool or tape out to all of our buyers that might be interested in that asset class. And we get bids for them. And then it's up to the seller to determine if they want to accept the bids or counter. And that's that. Yeah.
Okay. So what's the biggest Well, benefit to your clients and people who should know about Note Pros and how to the pros or the benefits and the expectations for working with Note Pros, but also what are some of the challenges for you in finding them and the client side of it anyway.
Yeah. Okay. Good question. So pros and cons. The pro would be that we are pretty specific in terms of this is the only thing that we do. We're not lenders or anything like that. What we do is we have relationships, built-in relationships, and we're actually gaining more buyers and sellers every single day. So in terms of sellers, that's where we want to connect with more people because we can offer them the ability to recycle their capital. And if they have already a buyer base that they're connected with, and it might be 3 or 4 different buyers or some of these bottom of the barrel buyers that are reaching out to these guys all the time, we have a significantly larger Rolodex, if you will, of buyers. And so we can just say, hey, give us the tape. We'll take it from there. Within about 2 weeks, we'll come back to you with bids, and you don't have to spend any time managing any of it. Yeah, sure, we're going to come to you with some questions and maybe some file requests. And after that, we'll get you some bids and you can go from there. And we'll walk you through the whole process too, what to expect, et cetera. So that's where we benefit sellers. Let them recycle their capital. Mind you, the more buyers you have, the higher bids you're going to get, right? Because yeah, sure, everyone's willing to put 50 cents on the dollar for some of these notes, but how many are willing to put 90 or 100? We got a bid in today on a $6 million pool, close to about 92%, which is pretty good, especially because they're smaller properties, smaller loans, which means more work for more loans. And this is actually a new buyer that we're working with. So it's really important for us to always bring in new buyers. So that's how we benefit sellers, is really being able to bring them the best buyer at the time, because some people have a lot of cash and they need to put it to work. And some are a little tighter, and so they're not going to be as aggressive. We know who needs the loans at that time. We, like I said, have built relationships. The con is our cost. We are going to be typically a 2% fee on a non-performing loan. And you won't have that if you're doing it in-house, but you're going to have your own overhead to deal with. So that's the con.
Yep.
In the buyers, we have significant volume from guys that they would never have access to before.
Right.
So this industry, because it's highly fractionalized, there's a lot of different players. There's only so many people in your Rolodex, right? And so, yeah, you might have 3 or 4 buyer or sellers, and they're consistently giving you deal flow. But what if you want to grow? Well, you're going to have to expand your supply. And so that's exactly what we do, is we expand supply for our buyers. The more supply that they have, the more options that they have, the better deals that they're going to get from their side.
Right.
Yeah.
Okay. How are these pooled? Are they regional?
That's a really good question. It really depends on the lender. Some of our lenders are very focused. We have lenders that only lend in the state that they live in. We have lenders that only really lend in the city and county that they live in. And then we have fully national lenders that we work with, all 50 states.
Okay. But then the buyers who are, the ones we were talking about before, who may be hoping to acquire and work on these properties, I imagine they don't want the things spread all over the U.S. where they don't have crews or teams to go work on them.
Yeah, good question. So let's talk about the buyer who ends up wanting to rent these properties out if they end up having to foreclose on them.
Mm-hmm.
Well, they have certain markets that they work in. And for example, Los Angeles is not one of them. And Los Angeles is obviously a large market. So they'll bid on a carve out, which means, let's say we give them 100 loans. They might only bid on 60 of them.
I see.
And so and it just depends. If they're the best, highest price for those 60, then they might get them. And then if someone else comes in and bids all 100 loans, depending on where the pricing comes in, it's really up to the seller on what they want to do. Do they want to accept the 40 from one and 60 from another, or how do they want to do it? Typically, our buyers are not too specific geographically, but some of them are very specific. A lot of people actually want New York loans right now. That's really what a lot of people want. And 3 to 6 months ago, Florida. Everyone wanted Florida. Not today, but 3 to 6 months ago.
Well, okay. So talk first about why Florida is so bad, and then what's going on in New York. If you have a few more minutes here. Sure.
Florida had 30% year over year growth for 3-4 years in a row, and that's just not sustainable. And so we've seen in some parts, larger declines in values.
So
some as much as 30-40% correction.
Okay.
Exactly.
Okay.
And that's
values
more
are tanking, and it's not a good idea to go play in that market when that's happening.
Unless you can, it's a race to the bottom right now, right? And then we'll see what happens there. But New York, it's a metropolitan area. So any large metro is going to be high in demand. California, I just mentioned California earlier. A lot of people like the California loans, but again, some people don't. It just depends on on their own specifics and their own criteria and buy boxes.
Yeah. I think coming from Arizona, I think it's always interesting because we hear about and see a lot of people making an exodus from California, and they come over here, they sell their house and move over here, and all these people are leaving. And I'm like, yeah, but somebody's buying their house when they sell it.
Yeah, we're seeing that too. I mean, because I'm from California, so I live in Los Angeles, and a lot of people have left, and now people are starting to come back, or at least other people are still coming here. So it's kind of interesting. But
it's a beautiful area for sure.
Yeah, that's why I live here.
Yep. That's why half of Arizona invades California every summer.
Yeah, makes sense.
Yeah. Okay, Blake. So, a reflection question as we wrap things up. What do you wish you would have known sooner about building wealth and success earlier in your career?
Yeah, great question. What do I wish I knew earlier? I wasn't really into finance growing up. In fact, when I was job hunting, when I was working at the citrus company, I had talked to a mentor, and one of the things I told him was I don't want to be in finance. I just was not very good with numbers. I didn't really understand investing too much. And that was really eye-opening to me, is realizing that you can invest in debt. I had no idea you could do that. Right. But it's very popular, especially with institutions and large players.
Yep. You look at some of the biggest buildings in the world, they're lenders.
Oh yeah, absolutely. So for me, it was just learning finance and understanding it and not being afraid of it. Oftentimes it's just a language barrier, and just understanding the language, and then you go, okay, this is actually significantly easier than I thought. So yeah.
Right. Yeah, wrapping your brain around it. There was a lady I know who was good at math, but she hated it until you put a dollar sign in front of it, and then it was a mental, limiting belief or something, where all of a sudden now she loved math. And funny, right? She became really interested in finances. Very successful, actually. Right. Okay, great. Thanks, Blake. Thanks for all that. Having a little note clinic for us here today. Appreciate it.
Yeah, absolutely.
So if people would like to connect with you and learn more about you and or Note Pros, what can they do? Where should they go?
Yeah, you can email me at blake@note-pros.com. You can also go to note-pros.com website. Very limited right now. We're in the process of building that out. But feel free to connect with me by sending me an email. That's the best way.
All right. Excellent. Well, thank you everybody for listening and watching. Thank you, Blake McGilvray.
Yeah.
All right.
Nailed it.
Good enough. All right. Thank you for joining today. Appreciate you sharing your insights into real estate markets, as well as the bigger picture of lending in real estate. Thank you.
Yeah, you got it. Appreciate you coming on. Thank you.
Inspired by our guests? Visit phoenixprosperitypodcast.com/guest and join us on the show and share your success story with Tim. The spotlight awaits.